Are you afraid of a HELOC? Does the idea of having a variable rate interest loan scare you? Well, I'm here to share with you something that not everybody knows. That is that not all HELOCs have variable changing interest rates. And you can actually convert your home equity line of credit into a fixed rate loan. In this video, I'm gonna share with you how to convert your HELOC into a fixed rate product, what the pros and the cons are, and also share with you how to decide whether or not locking in a rate on your HELOC and converting it is a good or bad option for your situation. Let's get into it. What is up, everybody? Welcome back to the channel. If you didn't know already, my name's Jay Costa. I'm a real estate agent and investor and developer here in Northern New Jersey. And if you get value out of this video, please hit that like button down below and also consider subscribing because we are building a pretty tightly knit community here of like-minded individuals around the country and outside of the country as well, looking to build wealth in real estate. Oftentimes, more specifically using a home equity line of credit in order to do so. By the way, if you'd like to support our channel even more, you can now join for, I believe, $2.99 a month and be a supporter of the channel. With that, you'll get personal and private advice from me on real estate investing, HELOCs, among anything else that you'd like to ask me questions about in regards to the topics that we cover on the channel. This is a new feature of our channel that I'm excited to share with you guys as we grow. So if you have any questions or comments, drop a comment in the comment section down below. Would love to talk to you guys. Now let's get to it. So if you're already aware of my previous HELOC videos, I tend to be a little bit more conservative than most out there in regards to HELOC usage. I always warn of the risks involved when you use any variable rate loan product in real estate. And the reason is it removes the biggest advantage that real estate and real estate investing has. That is the long-term, low or relatively low interest rate loan, such as a 30-year fixed rate mortgage. Because of this, I repetitively preach that HELOC should really not be a long-term solution, but more of access to short-term capital with a plan to pay it back or pay it off in a short amount of time, like a year or so. This is in order to protect you from future interest rate hikes and fluctuations in the market. Many people think that once you draw a balance on a HELOC, you are susceptible and subject to interest rate hikes in the future. But there is a way for you to lock your HELOC at a fixed interest rate. Many lenders allow you to actually lock in your HELOC and kind of convert it into something that's way more similar to a home equity loan or even a flat out second mortgage on your home. Here's how it works. You call your lender that you have your HELOC with and tell them that you'd like to lock in your interest rate. They will then ask you how much you want to draw off of your HELOC and for how long a period of time. The interest rate will depend on how much you're taking out as well as for how long, but it most likely will be higher than the interest rate that you're currently paying at that moment on the variable rate HELOC that you have. If you didn't already know how interest rates work on a HELOC, I definitely recommend you check out a previous video of mine that I'll put a link in the description box down below, as well as up in the corner. This video basically shows you how HELOC rates and HELOC payments are calculated. So definitely check that out if you want to learn more. But generally speaking, HELOC interest rates are based off of the prime rate plus a certain margin. So for instance, I talked about this in a previous video. My margin is 1.06%. So if the current prime rate is 8.25%, that would mean my current APR with the margin is 9.31%. But when you choose to lock in your interest rate on your HELOC, this is obviously to protect you from future rate increases, but the lender also wants protection as well. So that's not going to come for free. So they're going to charge you an additional margin on top of that margin in order to have a fixed rate HELOC plan. That amount of margin will depend on your income as well as how much you're taking out and your credit. In addition, the payment that you will have after you convert your HELOC balance to a locked interest rate will be not only interest only, like a HELOC during the draw period, but it would be interest plus principal. So the monthly payment will be higher, but you will be paying down that balance as time goes on. As with most things in regards to a HELOC, the details will depend on the lender. So definitely ask your lender a bunch of questions so you know exactly what you're getting yourself into and signing up for. That way you can understand what your options are and the best plan of action for you in your situation. But as of now, most HELOC lenders do allow this as an option, and many actually give you the option to have multiple fixed loans as part of your HELOC. For instance, US Bank, who we've talked about in previous videos on where I share the top lenders, HELOC lenders in 2023. If you haven't watched that video as well, I'll put a link in the description box down below as well as up in the corner. But that was one of the banks that I did recommend across the country for a home equity line of credit. So US Bank offers this where you can have up to 3 different loans as part of your home equity line of credit. They call this their fixed rate option HELOC, and they state on their website that once you close on a HELOC, you have the option to lock in a fixed interest rate for up to 20 years on some or all of the money you borrow. That way, if interest rates rise in the future, your fixed rate options won't. You can do this at any time during your draw period. You can have up to 3 active locks on your HELOC at one time. You can unlock or relock a fixed rate for some or all of the balance without fees during your draw period. As you pay down your locked balances, your available line of credit amount increases, and you can continue to use it during your draw period. And your monthly payments for any fixed lock options will include both principal and interest. US Bank also provides a great example that we'll go through right now. It'll give you a great idea and understanding of how this option works when you have fixed rate loans and multiple, up to 3 of them as part of your HELOC, as well as help you understand which situations you may want to lock in your rate for and which situations you may not. So let's say you open up a HELOC of $100,000. To consolidate your consumer and credit card debt, you take $35,000 and you take it out of your HELOC, but at a fixed rate. And you're able to lock in an interest rate on this $35,000 of 8.95%. Next, you choose to remodel your kitchen. Since you aren't sure how much money you'll need or not need for this project, you decide to take this money out of the standard HELOC, paying the variable and adjustable interest rate. And this ends up costing about $25,000 at that variable rate. Then to finish the kitchen, you need new appliances, but you know that's gonna cost $15,000. So you decide to take that $15,000 out of the HELOC at a locked rate. You've now taken out and utilized $75,000 of the $100,000 of your HELOC. Some of it is fixed rate, 2 parts is fixed, and then the rest for the kitchen is at a variable rate. So you'll still have $25,000 available on your HELOC. Plus, as you pay off all 3 of these parts of your HELOC, but more specifically, the part for the appliances, the $15,000, as well as the part for the consumer debt, because those are going to be, you'll be forced to pay both principal and interest, where on the $25,000 for the kitchen is just interest until you get out of the initial draw period, which is about 5 to 10 years. So what are the pros and what are the cons of doing this and converting your HELOC into fixed rate product? Well, the number one positive, the number one pro is obviously it gives you a fixed rate. So because of that fixed rate, you're gonna have more peace of mind. And depending on what you're using your HELOC money for, that peace of mind can be very much worth it. The fixed rate option also gives you a set cost, like a specific cost that you know exactly how much you have to pay every single month for a certain period of time. This is as opposed to being stuck with interest rates going up and you being stuck with a payment that you can't afford. In addition, like I said before, unlike a standard HELOC where during the draw period you only have to pay interest only, when you have a fixed rate option, when you choose to take a certain amount of money out of your HELOC and pay it with a fixed rate, you are forced to pay both principal and interest. So even though your monthly payment will be higher than as part of the variable rate HELOC, you will be paying it down and you know exactly what rate you're paying and exactly what your payment is. The fixed rate HELOC option is great for long-term loans where you need the money or you need to pay it back in a long time frame, as well as for projects or something that you know exactly how much you need. So what are the cons of converting your HELOC to a fixed rate HELOC? Well, obviously the biggest con is you're gonna have a higher interest rate. Like I said, the lender is giving you protection from future interest rate hikes, but they're not gonna do that for free. So this is not a good situation, or this is not a good option if you don't know exactly how much you're going to need, because you may actually ask for maybe more than what you actually need, then you're paying unnecessary interest on that loan, on that money that's borrowed. So should you convert your HELOC into a fixed rate loan or fixed rate HELOC? This is going to depend on 2 factors. 1, what are you using your HELOC money for? And 2, how long do you need the money for? If you have a specific project or expenditure that you know exactly how much you need and exactly how long you need it for, it may be worth it to pay that little bit higher interest rate in order to lock in the payment for peace of mind, as well as to have a controlled cost that you know is not going to change. This is especially true if it's going to be long term. By long term, I mean more than a year to a year and a half. For instance, let's use that example that US Bank provided. If you took money out to consolidate consumer and credit card debt, you are definitely going to want to lock in that rate, because you know it's going to take a long time to pay it off, and you also want to be kind of forced to pay both principal and interest instead of just treading water, paying interest only, while you may not be able to control yourself and run up more credit card debt on the side. And even with the higher interest rate on the fixed rate option when compared to a regular HELOC, it's still going to be much, much lower than what you pay with other, consumer debt loan products like just a personal loan or especially credit card debt. But if you do not know the amount that you need precisely, and you don't know for how long, and you know it may be short term, keeping the money that you're taking out of your HELOC as a variable rate HELOC may be worth it in order to give you some flexibility. It will also give you the option to just pay interest only. Like I said, make sure just for short-term purposes, instead of having to be forced with a higher monthly payment of interest and principal like the fixed rate option. So if you only need it short-term, I would definitely recommend sticking with your standard HELOC, especially because if you really think about it, if it's only short-term, the certainty that you're getting from the fixed rate HELOC is only for a small period of time. So you may as well save on the interest, but you have to have an exit strategy in place like we've discussed in other videos. All in all, locking in the rate on your HELOC may be a no-brainer given the situation in order to give you peace of mind and a controlled cost on the money that you're borrowing. And depending on how much in addition your lender charges for that locked-in rate, that peace of mind may be worth every penny. That is it for today, guys. Thank you so much for watching. Drop a comment in the comment section down below about what you think about this option. Do you have any experience with it, and what was the experience like? Or maybe you wish that you locked in. I mean, rates are much higher now than they were a year or two ago, of course. Do you wish that you locked in a rate a year ago and you didn't, and now you're stuck with a high interest rate? Drop a comment in the comment section down below. Give me any feedback. Would love to talk to you guys, and I will see you next time.